Also, we're really pleased to be talking to Kulluna Irada's board members. And of course, we're happy to also welcome LOGI's advisory board members, in addition to a very special friend, Ms. Carol Nakhle, who is joining us also today. Of course, Carol بغنى عن التعريف is the expert when it comes to not just modeling, but all the microeconomic aspects of the oil and gas and the contracts. So without further ado, let me start by just putting a bit of a framework around why we're actually doing this and why we decided to collaborate on this issue in specific. So back in 2017, as Hala mentioned, LOGI, Kulluna Irada, Publish What You Pay, and other like-minded organizations, we became quite vocal in Lebanon about contract transparency. So in particular, we wanted the soon-to-be signed contracts in Lebanon to be published. And we, indeed, in 2018, they did. In March 2018, the government responded, the LPA, by publishing the first two signed exploration and production agreements. We became actually the first East Med country to publish these. We were back then, if I'm not mistaken, number 27th around the world. So in partnership, as I stated, with Kulluna Irada, and we are supported as LOGI by Heinrich Boyle Foundation, we have asked OpenOil to develop a financial model based on the disclosed agreements. Now, just briefly to introduce Johnny to you. Johnny West is the co-founder and director of OpenOil. So OpenOil is a Berlin-based company with a mission, and the mission is to create open data framework for managing natural resources, but at a supranational level. So they aim to achieve this by providing services which increase transparency and cost-benefit analysis of the extractive industries all along. I had personally the pleasure and the honor to accompany Johnny on some very, very interesting missions across MENA, and I can assure you that Johnny will be delivering all that he is going to deliver today with a lot of passion, knowledge, and experience. And I would really sincerely urge you to reach out, whether now by questions or afterwards, with a lot of remarks or comments. He is more than happy to answer all of these. Just to end on a note of why we're doing it, and to reiterate what Hala was just said, for us, having these contracts disclosed was only a means and not the end in itself. And that's usually the misconception about transparency of things. So having the contracts disclosed was the milestone, and the ultimate end is to be able to use this transparency in order to understand what we have actually signed on to be able to contribute to this discussion of the fairness of the deal, to propose in the longer run reforms or better ways to increase the deal to the benefit of the country and the Lebanese. So the aim of it is to be part and to engage effectively in this very relevant discussion. At the end of the day, resource governance is all about maximizing economic benefit in a very equitable manner, and understanding and getting and having that tool to allow us to make that assessment is primary. And this is what we really need. This is the point from which we need to embark in a scientific way if we are ever to be able to sit at the discussion table. So I'll end here. And with this, and without further ado, I'd like to invite Johnny to take the floor and take us through 1 hour of exciting financial modeling. So Johnny, over to you.
Thank you. That's what I love to hear. Exciting financial modeling, which is my reality, but very few other people's. So a time check. It's 14 past the hour. I'm aware, I think, that the purpose of this meeting is to have as much time as possible for questions. I'm going to assume that I should try and get through this presentation, which I believe Stephanie is going to be kind enough to put up on the screen right now, in no more than 30 minutes maximum. So, Stephanie, I believe it would be Stephanie that's putting it up. Hello?
No. Do you have something to share?
I'm sorry.
Yes,
Yes.
I think you meant Christelle. Hala, if you can allow me to share my screen, I have the presentation.
I'm sorry. Yes.
It's done.
Sorry. Yes. Right. So, although we've been looking at this for a long time, in fact, we've kind of sketched out the first draft right at the end of 2017 after the bid round closed, but there were a number of obstacles and delays. Events have moved so fast this year that there was a bit of a moving scope to what essentially we tried to analyze and model. So most of what the original brief was in the, you know, the issues you can see there under one, the story so far. Fair deal question, why different terms in the two blocks, some features of the anatomy of the fiscal regime. But really just in the last 3 to 4 weeks, I would say, as we were closing out, it became clear to me that we needed to attempt to integrate some of the you know, situation we find ourselves in now, which is so radical, with its short and long-term ramifications uncertain. So sections 2 and 3 are essentially, you know, have been developed in the last few months in general thinking, and really explicitly in the last month or so. So I'm proposing actually to get through block 1 as quickly as possible and go more on to 2 and 3, which is also because the results in block 1 are fairly uncontroversial, in fact. So if we can move forward and through to the next slide. So we are using here the government take metric, which is also called by the IMF the AETR, which you can see in this chart here, the average effective tax rate, to address the so-called fair deal question. Now, that question implies there is a straightforward way to compare one negotiated outcome with another. That's not really true. However, we are caught in a tension between the need on the one hand to provide some kind of apples for apples comparison and the need to be extremely cautious about the limits of what those comparisons can tell you, for a long list of reasons. And I can go into that long list of reasons very happily, because I personally believe we need to find better ways and better quantitative ways of analyzing these metrics than the government take metric and the AETR. But it is in fact what we have for the moment. So here we are. So under an approach to, and what the government take means is what's the share of the profits in lay speak. After you've removed all of the associated costs that the investor had, you then have a pool of profits. How much of that goes to the government as the owner of the resource? How much of that goes to the companies as the investor who took the technical and financial risk? And under an approach which I will explain but shortly, because as I say, I believe I'd like to encourage us to look at the implications of where we are now in 2020. We arrive at 56% take in across a number of different scenarios, which we've averaged out. And then I've put them into this chart you can see here, which shows you comparative government shares of profit in all of those different countries from an acknowledged expert called Daniel Johnston. Okay, so if we can flip, so my general outcome is government take metrics are certainly too speculative and imprecise to be very closely concerned about 1, 2, 3, 4% here and there. They may be useful at the margins for determining roughly where on the chart you are. Are you over towards the left or down towards the right? And but then there are a whole lot of non-quantitative reasons why you could naturally be in one part of the spectrum than another. So even then, you need to add in those non-quantitative reasons to think about whether that all adds up to a reasonable deal. So the end result is that you're often left saying, well, there's no reason, and this is how I would put it, there is no reason to suppose that this was a bad deal. But notice I'm expressing this in the negative rather than the positive. I'm not saying we definitely have the data to conclude it was. There is no reason, no active reason to suppose that this was a bad deal or indeed a badly negotiated deal, because you're in the middle of the pack, and that's roughly what you'd expect for Lebanon's circumstances if we flip forward. But I want to say beyond that degree of precision, we're getting into dangerous territory, and I'm aware that technical people like to discuss the niceties of this endlessly, and I'm very happy to, but I'm not quite sure how much of this 90 minutes we should be taking up with this. So here's a little bit of background detail about how that figure has been compiled. I actually I merged the two blocks, although they have different results. Block 4 giving higher results than block 9 because they were bid at the same time. There was only one bid in each case, and it was the same companies. So I've decided, for the sake of accessibility, to treat it as a package deal. We do have the broken out numbers by block as needed, and then simply compiled it across a very wide range of scenarios. One thing that the public presentation of the government take debate always mostly obscures is that you're presented with a particular figure as though the government take figure was a constant, whereas in fact it's a range, and it's a range in response to low profitability, high profitability, low prices, high prices, and so on. So we've taken that approach here. I understand, by the way, that this is the same general approach that the LPA took in developing their model, although I've not been able to see their model. We then also played with different possible development scenarios, which have different rate of return implications, and so on. We end up with a total of 128 permutations, 64 for each block, but then ran them through a filter of those where the rate of return to the investor was so low that we judged it unlikely that they would go ahead and develop in those cases, which then excludes 42. So what I'm saying is there are many ways to slice this pie. That's the particular way we've sliced it. That's what generated the 56% undiscounted figure in the chart you've just seen. If you flip forward one more screen, it also generates a 75% figure using a 10% discount rate compared to some numbers published by Rystad. We can't see any of the underlying models, and the differences and assumptions you can put into the models can easily make a government take figure vary with the same contract by 5, 10, even 15%, which is again another reason to be cautious. However, here are some numbers for point government take estimates from Rystad using a 10% discount rate. Here is where the first round bid for Lebanon fits in with a 10% discount rate. There's a technical reason why the government take would be higher under a discount rather than a lack of discount. Again, I encourage postponement until we've dealt with questions of higher public interest, or a separate call to discuss the technical details. But the same general result, middle of the pack, which given Lebanon was a frontier province at the time these agreements were signed, the prospectivity is mainly around gas, is again okay. There is no reason to suppose that this was badly negotiated or a bad deal. Flip forward. Next slide, please. Lastly, after having compiled ours, where I used two flavors of government take, the undiscounted and a 10% nominal discount rate, I talked to the LPA, who told me they used a 5% real discount rate, then ran the numbers again. We get marginally different results to their model under their discount rate. Those differences don't bother me because of the overall degree of uncertainty and the factors we can't see of the assumptions going into their model that we can't see, and so on and so on. They are, in modeling speak, in my view, not material. So and they can't be verified unless the LPA publishes its model, which it's not going to do, because even though if it's cancelled the second round, at some stage it may want to initiate the second round, and they develop this model for bid evaluation. So again, this was the question which we were told, and I know from experience is very commonly the question of most urgency for civil society, the fair deal question. And our results tell us that there is no reason to suppose that there has been anything spectacularly good or bad in it. And unless we're going to get block by block prospectivity data, which would give us more insight, or the LPA is going to publish their model, which would give us more insight. I'm not sure how much return there is to trying to go into more granular detail on this, because the margins of uncertainty we have don't affect the materiality of the outcome in terms of those broad conclusions I've been telling you. It's in the middle of the pack. That's an okay result for a frontier province with gas prospectivity. So then we come to where we are now, if we can flip forward. Oh, sorry, no, there's still a couple of aspects of, no, sorry, please do flip forward one screen. This shows you the difference in outcomes, holding all other assumptions equal in terms of we assume the same price, we assume the same development time, we assume the same cost structures between blocks 4 and block 9. Block 4, of course, now with a dry well. If assuming they were developed under LNG, the interesting part of this analysis, I think, would be similar if they had been developed with a pipeline, although the revenue profiles would look different. Block 4, I think what is known in public is that Block 4 got better terms, and specifically the two biddable terms, which is that the profit share ratio for the government is higher, and the cost recovery ceiling in Block 4 is lower, which is better for the government. And that's actually what we see here in the model. It's kind of interesting to see those terms reflected, quantified. So Block 4 earns more for the government under all of these sets of assumptions by a little bit in the early years of production of a project. Then there is a weird crossover year in the middle where Block 9 earns more than Block 4. But then we go back to Block 4 earning a lot more, substantially more than Block 9 in the mature phase of the project. And this can be explained fairly straightforwardly. The beginning increase in earnings from Block 4 is due to the lower cost recovery in the field. Again, happy to take questions later, but simply put, the speed with which the investor can recover their sunk costs from the capital development stage. That is what the ceiling is, and it's capped at 60%, which means that 60% of all revenues in those early years, no more than 60% can go to recovering those costs, which therefore means a larger amount is available for profit share. And that's why we're seeing the government is getting a profit share from a larger profit share pool in Block 4. And then at the end, we're seeing the effect of the much higher maximum range of profit share in Block 4, which is potentially 55%, whereas in Block 9, it's only 40%. They both start at 30, but then they both rise up to very different ceilings. Block 4 from 30 to 55%, Block 9 from 30 to 40%, and that difference in the maximum, if the mature phase of the project reaches the maximum, and so that is the big difference you're seeing there in the back end of the project. Now, why the one-year crossover? Well, if you think about it, if Block 9 allows the investor to recover their costs more quickly, then the profit split, you've got two things. You've got how much money is in the profit split kitty in any given year, the size of the pie, and then you've got, well, what is the government's slice of that pie in that year? In both cases, you've got a mechanism which starts at 30%, but then climbs up through a mechanism known as the R factor. And that's a reflection of overall money in versus money out. So simply speaking, because investors got more of their money back more quickly in Block 9, because they were allowed to recover more, a higher percentage, there then follows this time in which Block 9 begins to move off the starting block in terms of increasing the profit split, going up from 30%, admittedly only towards 40%, but Block 9 has started to move off its 30% starting block base before Block 4 has, and that is the crossover. But Block 4 reaches that 1 or 2 years later and then very quickly climbs above it because it's going to a much higher ceiling. So that is the nature of the differences in the fiscal regimes, somewhat academic now because Block 4 is unlikely to be developed, but nevertheless there. I've been asked every time I've presented this before as to whether such differences can be explained. First of all, we don't have all of the possible reasons for those differences, but the first point is that such differences are very normal. This is a normal kind of difference and a normal degree of difference between one block and another block. The biggest single reason often for differences in terms offered is going to be block level prospectivity. You know, in this case, we know that the companies have spent a huge amount of money on the data, $43 million plus, which means they've probably developed very specific views about prospectivity. We are blind to that. We don't know what their views of prospectivity is with Block 4 compared to Block 9. Neither, in all probability, does the government. I'd be surprised if they have any more than a bare indication, and the biggest indication is the bid terms themselves. So that is often, perhaps even usually, the biggest single reason for differences offered in block terms. We do have the specific issue, of course, that part of Block 9 lies in territory which is part of the maritime dispute with Israel. And in commercial terms, that's going to increase the risk. And my natural response to increasing the risk is to seek more upside, risk-reward mantra. If I've got higher risk because there could be force majeure declared, or there could be an escalation of hostilities, or any of those things, I'm going to seek higher reward. Well, how can I seek higher reward at the negotiating stage? I can ask for better fiscal terms. So, or in a bid round, I can offer a lower bid. So it is quite possible or likely that that has influenced the lower bid terms for Block 9, and that would also be logical and reasonable. But these are speculations, we can't know. As I said, we can know that this is a normal variation in a normal degree. So if we could move on. And the last point here is that this is a stable fiscal regime. At very low rates of profitability, the royalty accounts for more, but then we quickly fall into a stable mix of fiscal tools. And again, I think that's all I want to say about that. If we can move forward, because I'm conscious of time. I'd like to get to where we are now. Okay, good. Thank you. Flip forward, please. The important thing to notice about this graph is that this is pre-COVID, pre-impact of COVID, certainly, on the global economy. We're seeing convergence and collapse in global gas prices over the last 18 months pre-COVID. Notably, the gas has long been essentially split into three global markets: Asia, Europe, and the US, which fluctuate, of course. And the other thing to bear in mind about gas is that far less of gas is sold in spot markets than crude oil. Far more of it is sold in so-called term contracts and quite complex gas sales agreements. So what we're looking at here is spot market data, which is a strong reflection of trends, but nevertheless important to bear in mind is a smaller percentage of total amount of commodity changing hands than you might think. So the Asian market has traditionally been extremely high. Europe in the middle, America, particularly since the development of shale gas in the mid-2000s, very low because there's huge supply and very, very flexible supply within the United States. So the patterns you see on the left-hand side of this chart have been more or less what has prevailed for many years, but we see 18 months ago this collapse and convergence before COVID. If we can flip to the next slide, please. And it's important to understand there is a big forward-looking structural element to this. Not only is there oversupply of LNG, which is most of the portion of gas which can be traded on spot markets, there is already nearly another, if the current market for LNG is around 400 million tons a year, there is another additional 200 million tons in projects that are already being built. And the nature of, I mean, this crisis is so dramatic, it could lead to some development projects being stopped, but that would be dramatic. The nature of the business with such high upfront costs tends to mean that once a project has been commissioned, it's going to happen. So I think we assume that most of that 200 million tons additional, representing another 50% increase in supply in the next decade, is going to happen. So not only do we have oversupply now, we have locked in structural oversupply for the next decade. That's global. And then specifically Europe, the geopolitics got harder in the last 12 months. We have the announcement. We don't want to pay too much credence to it because pipeline politics are all about announcements, but the announcement of the EastMed pipeline, Greece, Cyprus, and Israel. Meanwhile, Turkey, having redefined its maritime border to establish a direct border with Libya, where coincidentally it has troops and is an active supporter of one of the two contending governments, is claiming therefore that any pipeline to Europe would need the agreement of either or both of itself and its client state, Libya. So that, and on the other hand, we see EU energy policy already moving pre-COVID, moving faster now towards renewables, very well aware of the LNG oversupply currently, very well aware of the structural oversupply to come, getting not unproblematic, but nevertheless significant amounts of gas from Russia, and with a fairly aggressive green economy policy being implemented across the EU, with the fastest movement of any major economic group towards renewables. So, and the last 80% probability is the kind of wildcat generic exploration chance of success. If you flip to the next screen, you know, a global average. There are many reasons why you may raise or decrease this, but a global average chance of success, so to speak, is between 15 and 20% in a wildcat zone. Frankly, most companies' estimates of chances of success will have gone down as a result of the dry well in Block 4. We have one well which is committed by work obligation in Block 9 still to come. But the dry well in Block 4 will have already affected companies' views of exploration economics and their interest in what terms they want to offer in any potential second bid round. But the thing to focus on, I believe, is what is the consequence then of the global and regional situation in terms of development of the Lebanese offshore. And if we can move forward for that, please. Basically, if a pipeline to Europe is effectively off the table, then you are either looking at export within the region or development of a project which is nationally led, where demand is nationally led. And we face an issue really of we can no longer assume that all potential available reserves, and I want to be clear that as of now, we have no reserves in Lebanon. We have resource estimates because reserves in the technical sense can't be established except by successful drilling. We have a much vaguer, much fuzzier category of estimate which relates to resource estimates. And so you need to bear that in mind whenever you see or read figures relating to what kinds of resources Lebanon could have. But even if a certain amount of proven reserves were to be discovered now by a successful exploration well in Block 9 and then successful appraisal, leading to a declaration of commerciality and reserves figures. The current situation with global prices where they are and European policy where they are and regional dynamics where they are means you don't have a path to export, certainly not to Europe. And if you want to consider the regional possibilities, we can, but then at each case, regional politics comes in heavily. So within the region, for example, and this was an interesting observation which came out of the last presentation, what about Turkey? Well, yes, in theory, because Turkey, of course, is a big economy and an energy-hungry economy. But again, we are back to geopolitics, because if you develop a discovery in Block 9 and you want to run it to Turkey, you've only got two choices, either through Cypriot waters, and how are you going to get from Cypriot waters to Turkish waters? I mean, a joint shared multi-billion-dollar investment project between Cyprus and Turkey, the current geopolitics of that are not, measurable, or Syria, still at war with itself. So the circumstances in which you could, in fact, pipeline export to Turkey require black swan positive interventions in the geopolitics of the region. Elsewhere in the region, Jordan is a pipeline through Syria. Israel, totally not viable, or for any number of reasons. Egypt now going into surplus because of Zohr. Where else? Not sure. So that is the combination of the global and the regional factors leave us contemplating the idea that the total size of a discovery, even with proven reserves, is no longer the prime factor that could drive development or not of the offshore in Lebanon. If we move to the next slide. And that is I was looking for a different slide, which has, sorry, could you just go back one? Yes, this one. Excellent. So given that, I've essentially developed a number of different scenarios for the sector as a whole, because we began with the emphasis on the fair deal by looking at, but then once this global and regional market and geopolitical issues came into focus, it seemed as though there would be some value to be derived from trying to speculate around possible combinations of developments across a potential offshore sector in Lebanon as a whole, because we could also see from the other side the national political issues of economic crisis, public debt, power crisis, and the perception in public opinion that gas has the potential to partially or wholly resolve any or all of those questions. So here is an attempt to put numbers on those things. Guided by the previous thinking, which I've just explained, the scenarios that you see in dotted lines represent, they represent what an offshore development would look like if producible reserves are capped by factors beyond, national control, beyond the ability to set any terms attractive enough for companies, because you simply can't lay the pipeline for political reasons, or the LNG prices are nowhere near commercially viable for now or into the foreseeable future because of the oversupply in the pipeline in the pipeline of projects to come, which is a multi-year oversupply. If that's the case, then the top scenario you're seeing here, so the solid line, I should point out, represents 3% of Lebanon's annual budget, starting from about $20 billion today. The somewhat unsmooth curve in the beginning is against the IMF's specific estimates for the next 4 to 5 years. Then we've simply said, let's assume a uniform growth year on year of, I believe, 5%, which is below historical average. In fact, historical average this century has been more like 6%, I believe. But anyway, that's what is forming that smooth curve upwards there, of 3% of the government budget. And then the dotted lines are various different scenarios. A single field developed with LNG, relatively small. These specific assumptions are available. 2 fields developed by LNG. A mega field, which we're here defining as 10 TCF, is that biggest line you can see, which is the only one which crosses even 3% of government budget. But because of the revenue profiles to the government, 15 years time, and then it only holds it for, let's say, roughly a decade, and then it trails off again. 3% of the year-on-year annual budget. And the others never hit that target. So that's just to give a general scale to set against the public financing crisis, the budget deficit, and what is the potential of the offshore in this current environment, to address it. If we can flip forward. That just shows you a revenue profile under LNG, and I'm the one technical conclusion of the that follows from thinking that export markets are closed off, is to believe that there are limited circumstances under which a pipeline, so then you're talking about essentially national demand or national main plus auxiliary export possibly, leads you to an LNG type development profile rather than pipeline for a couple of technical reasons. In order to generate demand, you're essentially seeking to create a gas feedstock to substitute into the electricity grid, but that's going to take some time. And the economics of the pipeline essentially would mean that you wouldn't be able to take, although the pipeline in theory offers you better rate of return for the investment because you can produce more quickly than you can under LNG, the cap on absorbable production caused by the new situation means you're not able to take advantage of that greater ability. And so there are very limited ranges in which running a pipeline to a national market would be commercially promising. But we can get into the detail of that more if you like later on. This is an LNG revenue profile to the government. It's much flatter and different to a conventional development path where perhaps you're used to seeing you rise up very quickly to a plateau of production, which peaks for over 2, 3, 4 years and then declines gradually. Whereas in LNG, you are producing to the maximum of your LNG processing plant from the time you install it. And in revenue terms, that means the first bit is the investor is recovering costs. And then when they've recovered costs, you get to fairly stable share, fairly stable royalties, and then share or profit splits, and then other profit-based taxes such as corporate income taxes, which is why you get this shift up in the early 2030s. But that's roughly speaking what a revenue profile is going to look like if the project is developed using LNG. Flip forward, please. So I'm already 5 minutes over time. These are the assumptions going into the previous graph. The only thing I want to pick up here also is the question of debt, the point near the bottom. So we've seen that under this, essentially this production constraint, there's a limit to the kinds of development scenarios that are going to be viable. And that in turn means there's a limit to potential revenue flows to governments, no matter what the size of the discovery. That also applies to debt. If you run a net present value calculation to revenues to the government on the 10 trillion cubic feet field that was in the biggest dotted line in the chart 2 or 3 slides back, you're looking at a net present value of $3 to $4 billion. And by the way, the price assumption in the base scenario here is $6 per million BTU, which is more than double where the global market is right now. The relevant metric to use in considering whether those offshore revenues could address the debt crisis is to see what all of those revenues spread out over 20 or 30 years in the future might be worth now, which is why it's called net present value. And when you contract in all of those future revenues under a 10% discount rate, which I think is reasonable for the state of Lebanon at the current time, you get between $3 and $4 billion current value of total future earnings. But the current public debt, as I understand it, is of 80 billion. Well, so your total revenues could theoretically be worth roughly what debt servicing is for a year on the current debt. And it's worth pointing out that if there were to be a question in the second round, it's been ruled out in the first round, of direct state participation, which is possible under the adjusted model contract for the second round. You should think about the extra debt that would normally need to be incurred to pay for that participation under the standard terms of what's called a soft carry, where the state would have to contribute in cash or borrow from somewhere at interest its cash call contributions to the development phase of the project. Flip forward, please. Very rough view of break-even prices for a company. Sorry, this graphic could be better presented, but it is against different field sizes and prices. And broadly speaking, that showing that under either LNG or pipeline, although their profiles are different for break-even, the current prices of $2.5, $3 per million BTU are nowhere near. And remember the length of time of investment here for the kind of development that would be required here in the offshore, which is very distinct, let's say, from an onshore shale development in the United States. There's such a long-term commitment of the investment that you shouldn't think of these ranges as being, oh, well, the minute that the spot market goes to $6 or $7 a barrel, the company is then going to be comfortable investing because it has a rate of return above 10% over the lifetime of the project, because it's going to want to run huge amounts of calculations around the continued volatility of price. There's going to be a considerable buffer. So this graphic simply shows you what would achieve rates of return of above 10% if the price held steady, which is an entirely unrealistic assumption for the entire lifetime of 30 years of a project. But in practice, the insecurity caused by the ongoing volatility of price is going to mean that we should be more conservative than this in terms of estimating real break-even prices for companies to commit to a final investment decision. Move forward, please. So lastly, then, all of this is bringing us to consider, and I've really been doing this in the last 10 days to 2 weeks. So this is a toy illustration of the interaction between power generation from a 10 TCF field developed by LNG with Lebanon's current and projected future growth of electricity supply, because then this is order of magnitude, what would the interaction be? The other reason to think that a nationally led project would be more likely to be LNG is because, of course, LNG is going to enable marginal export much better than a pipeline-led project. And of course, Électricité de Liban have already been considering, seems like there's an issue around the financing, but have already been considering LNG regasification to get imported LNG feedstock for the power network. So the blue line is just a very crude compilation of the power generated by the current network and some measure of, it also assumes that an expanded grid would be able to absorb and replace most of the market currently taken by the private generator market, which is an optimistic assumption, even, of course, if those prices, and you all know this far better than me, are super, super high. There is, of course, huge intrinsic economic efficiency to getting gas feedstock replacement, but there are all kinds of frictions in the system. The political sensitivity of price reform, which is a prerequisite for this to be able to work, some of the commercial considerations for the companies, which we will go on to consider. But this is pure order of dimension, that a 10 trillion cubic feet field discovered in Block 9 by an exploration well, let's say in December, being optimistic, and then appraised, and then going into production through development, which said first production was in 2025, would look something like this if we assume that all of it could be transferred into replacing imported fuel oil and fragile hydropower to power supply in Lebanon. And then, of course, if you did have such an LNG-driven project, you do have the prospect for exports as and when those fundamentals shift radically in your favor in and around the export market. There was one other thing I wanted to point out here. Oh yes, and the other thing to say is that you would then have a very specific target and motivation and a reasonable timeline to be able to undertake all of those very challenging power sector reforms in the country. From the moment you had a discovery and those discussions began, of course, you would have 3, 4, 5 years to say, look, Électricité de Liban can massively cut its costs, which of course we know are in fact now largely covered by the government, adding to the $80 billion debt, if it gets the gas feedstock replacement. But that can only happen if, price liberalization, blah, 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 all of those. And those are, so apologies for the crudeness of this, but this is simply an order of magnitude illustration to get us into the game of considering, because I believe this is the next stage of consideration, what does a nationally led development of the offshore look like? And if we go to the final slide, please. Price, none of this is viable or even worth engaging as the companies seriously on before you see $5 per million BTU. And as I said, that's there's a very reasonable case to say that number is higher than $5. The major issue then is to think about what this means from the commercial perspective. Companies don't like, being locked into national markets in general. The way that's been dealt with historically is that, you know, there are clauses in most, not all, but most upstream agreements which say, here are the terms under which the government can compel the companies to supply the local market. And here are the terms which they must offer. So it's expressed as something called a domestic market obligation, which says, you know, the government has the right to be the prime customer, but then it must pay according to these conditions. And, you know, mostly, of course, with the companies are concerned about making sure they get something close to an international market price. So that's the way it's dealt with on a contractual basis. However, there's a difference in the real world between even what's been agreed in a contract and, you know, what it looks like once you've spent $4 billion to develop the field, and Lebanon is your only market. So that would be the sensitivity for companies to begin with. Then add to that, it's not just Lebanon, the country, it's the Lebanese government or a state-owned entity, but, you know, an entity owned by the Lebanese government. So from the commercial perspective, you know, what happens if there's a commercial dispute? What do I think my chances are of redress against the Lebanese government in, you know, a Lebanese court system, for example? And with Lebanon, you have a third element, which is it's not just the fact that it's the government, it's the fact that the government already has a public debt of 150% of GDP. So is it good for it? You know, the money that I need to be paid to be able to make this a commercially viable project. And, you know, this isn't an academic dispute. In Egypt, before the discovery of Zohr, you know, we just got to a stage where, which was in 2014, we just got to a stage where, you know, the government owed the companies billions. The exact figure escapes me, but from memory, I want to say something over $10 billion in back payments for gas, which the government was invoking its domestic market obligation right to feed into the local market because of, you know, an incredibly energy hungry market, delaying on payments. And, you know, whatever the terms of the contract say, and there could be interest, typically are interest charges attached to that. But from the company's perspective, you know, the bills are going up and up and up and up. And we've got to a stage where the companies had started to cut off supplies of the gas in order to try and get paid. So the entire state of Egypt had become like, you know, a poor customer that hadn't fed the gas meter. And so these are not theoretical issues. The translation of that, therefore, into bid round terms, Block 9 terms are what they are, although there's plenty of scope for renegotiation, even without formal renegotiation of the upstream, because especially if you have LNG, you have a bunch of associated agreements which have not yet been completed, a gas sales agreement, an LNG processing agreement, how the LNG plant is treated, it's in tax terms and so on. But let's look at the second bid round. What does it then mean? Well, you've got to start any analysis of viability from what rates of return might look like for credible international investment, in my view, and work backwards from there. And the reality is that there is extra risk to this kind of development. I think it's possible that you could get some solutions involving IFI, International Financial Institution, guarantees and loans, because everyone has an interest in energy reform in Lebanon. Everyone has an interest in attempting to increase geopolitical stability in Lebanon and so on. But nevertheless, it remains challenging. And there's, I think, little question that the kinds of terms that companies may offer for those kinds of projects, because they will be making their own calculations around export anyway, are therefore going to be lower in terms of tax take and government take. And you then, or you in civil society, this then becomes a kind of policy question, which in my view is one of numbers and international experts and so on, is a question for Lebanese citizens, is what then is acceptable to you if companies, as a response to these changed conditions, offer lower terms? Because I can guarantee the numbers will say, if you go back to those first charts we saw, then, you know, the second round would not be in the middle. It would be over towards the right. It would be over towards, you know, the lowest paying government take returns to the state of Lebanon in terms of the flow of tax revenues from that project to the government expressed as a percentage of profits. However, if the essential line of thinking is that there are new short and longer term realities, and a massive global export potential is now off the table for a combination of reasons, then it follows that those comparison points that you've seen are historical data points, and it's no longer strictly apples for apples comparison. And so you can produce that graph, but then come to the false conclusion that therefore these lower terms are terrible or exploitative, where they may not be. And of course, the other factor is to consider that the benefits then to Lebanon, because of the crippling nature of subsidies, aren't just the tax take from the companies directly. They are the ability to harvest the huge genuine efficiency from substituting fuel oil imports for nationally produced gas, which currently is a massive burden on the state budget. So the net impact on state finances is much better than just the tax take from the companies. However, I haven't modeled that because that additional component also depends on, you know, a lot of complex stuff that we've come to quite late in this project, relating to, you know, power sector reform, price liberalization and things like that. But, you know, in conceptual terms, we can, as of now, be clear that, of course, the net benefit to state finances is not only the tax payments directly from the international companies, and the net benefits to Lebanon are not only the net effects for the government, because, of course, steady and readily supplyable electricity and cheaper electricity, arguably in the end, certainly than the private generator market, also has macroeconomic impacts greater than just the net public finance impact for the government of Lebanon. So those are things which I would encourage you to think of intensively as the next stage of research. And I've gone way over time, but that concludes my presentation. Thanks very much.
Thank you very much, Johnny, for the presentation. I think it's extremely intense. I have already one raised hand, which is Gabi Abdenour, and George earlier in the chat had asked whether it was time to ask the questions or whether we wait till the end. So maybe we start with you, Gabi, and then George, the floor will be yours.
Story of my life.
Thanks, Hala. George, go ahead, Habibi. Go ahead. Don't worry about it.
Go, Gabi, go.
Thanks for the presentation. But I mean, if we synthesize everything that was presented here, we're talking about a non-viable commercial proposition, the bottom line. The reason is, if the only off-taker of the gas is the government, considering what the creditworthiness of the government is, no commercial institution will finance this project. And you are left with basically government entities, export credit agencies, multilateral aid institutions who are subject to high political pressure to come up with the billions of dollars that are needed for this. And from a Lebanese taxpayer standpoint, and correct me if I'm wrong, it doesn't contribute much to the economy in the country. Is that a fair conclusion?
If you're asking me, maybe I would take all questions that are currently there and answer them in a round.
Okay, fair enough.
George, can you go pitch in?
Well, sure. First of all, thanks for a very informative presentation. My question is somewhat related to what Gabi asked, which is, it seems to me that a lot of the calculations made, whether it's the NPV of 3 billion, whether it's the graph that compares the output to the 3% of budget, all of those calculations are assuming, to use your words, Johnny, the black swan of potential exports. So you are left with an analysis that basically says the only client here is the national government and national demand, and that presupposes that the entire infrastructure of the country is effectively converted, which itself is going to require money for a government that is already bankrupt, and as a purchaser, also an unreliable purchaser in light of their the fiscal conditions. So it's really effectively a long-winded way of asking the same question. Is it, I mean, I can see the benefit of saving hard currency by no longer buying fuel, whether subsidized fuel or not. It's still a savings of hard currency needs. So there are benefits to the country for sure. The question is it a viable project for a company to come in and make that investment?
Okay, thank you, George. We'll take another question and then we'll let Johnny answer. Carol has her hand raised.
Yeah, I have, if I may, just a few comments and then a question for all of you. But of course, Johnny, given his expertise, may be in a better position to address. First of all, I'm very glad that Johnny highlighted the difference, I mean, the importance of really looking at the government take with caution, because unfortunately many people put too much emphasis on it and it doesn't really give us much meat and insights into what's going on with respect to the deal and the fiscal terms compared to elsewhere. But Johnny, this is better than what the debate was focused on in Lebanon at least a few years ago, where some so-called experts were comparing only the royalty rate between Lebanon and Israel. And that led them to make some unrealistic conclusion, to reach some unrealistic conclusion about whether the fiscal regime in Lebanon was competitive or not. So at least looking at the government take by combining various fiscal terms is more comprehensive than focusing on the simplistic selection of one single instrument, which leads to utterly the wrong conclusion. The second thing I wanted to raise is that what Johnny showed us today is, for me, is not a surprise, does not come as a surprise. It re-emphasizes what several experts have been saying over the last few years, but unfortunately their recommendations were not welcome because the sector remains highly politicized. And here I'm referring particularly to the potential contribution the sector would make to the Lebanese coffers and economy, whereby many warned, and then we were talking about oil and gas markets much healthier than what we have today. And I fully agree with Johnny, it's unlikely to see a rebound to the pre-2000, I don't know, 14 market conditions, especially for gas, even more so than oil. But even then people were warning, like, hold on a minute, don't expect a big bonanza. Yet our officials and the various government representatives refuse to listen because it does not win support from the electorate. So here is a big question that for let's say, whether it's Kulluna Irada or LOGI, how do you depoliticize the sector? And I'm finding that very, very difficult in a country where expectations were built quite high about something that we didn't really find. But my last comment, and that is something actually relates to, maybe it goes beyond just the fiscal term, because John, you said that there's no reason to suppose it was a bad deal. Well, one, if looks at it differently, if I look at the success or failure of a licensing round, of a bidding round, usually, of course, the more competition you have, the more successful the round is. So in this respect, I wonder, because Lebanon received only 2 bids from for 2 different blocks from the same consortium, whether we can really talk about the deal, whether it's good or bad. And this makes me think of one aspect of the legislation which limits the number of, not limits, actually, it specifies the number of companies or right holders who could join forces to bid for a license or a block, and they refer to minimum of 3 right holders. I never understood really, I mean, I understand where they come from, but I was never convinced by the necessity to implement, to follow this kind of restriction in the legislation, because one unintended consequence is actually limiting the competition, and as such limiting the success of the licensing round.
Great, thanks, Carol. Is that my round of questions? Shall I respond now?
Yes, please, Johnny.
Yeah, so I think we've got an elephant in the room, which is there any viable projects at all? And let me just deal with everything else first. So yes, Carol, look, you're taking your points in reverse order. Should perhaps phrase it more carefully. You're right about the single bid, and of course there's the time delay and for how long it's taken for the whole thing to get going for one reason or another. And one of the reasons it looks as though, big export market would be off the table anyway. I mean, let's say that prices hadn't collapsed and there was no COVID. We've still got the 2 big Israeli fields producing. We've still got Zoth, and we've still got a big discovery in Cyprus. The fields which are coming to production in the last decade are 60 trillion cubic feet, etc. That alone would make export to Europe really difficult, and export to any other market would always be problematic for commercial reasons. So that is another argument about. So maybe if I were to be more carefully phrase it, I'd say there's no reason from the modelling outcome. The government take outcome from the model doesn't give us any reason to suppose that it was a badly negotiated deal. But you're perfectly right. Of course, there could be many other proofs that it wasn't as well done as it could be. I mean, my own experience, just on this last point about 3 companies and not 3 companies, things like that often just creep in an entirely random fashion, because somebody, let's say in the LPA, went on a training somewhere or spoke to someone somewhere, and somehow it kind of filters in and then becomes part of the institutional policy before it's ever, rigorously examined. On the depoliticization of the sector, and people having said it for years, I'm sure you're right. I have wondered sometimes whether, and you will permit me as an outsider to say this, whether with, I don't know, 500,000 Lebanese citizens at any one time working in the Gulf countries, and the history you have, being the kind of the human resources of the Gulf economies to a massive extent, whether the paradigm of the way oil, has played in the Gulf economies created such a strong, template in popular imagination, which happens all over the place. But to be Lebanon and to be looking at Qatar, Saudi Arabia, and so on, I don't know, but I can entirely believe that it's been very difficult to depoliticize the sector. And on government take, yes. I mean, it's just, I'm looking for takers, by the way, but I feel like the time has come to write you are also right, Carol, in saying it's better than single instrument comparisons, our royalty versus their royalty. Of course it is, but it's, I don't think its limitations are as understood as they need to be. So we're forced to use it all the time, but I also, because there is no other way to do it, but I'm looking for takers for who wants to help me write a paper on what the limitations are and experiment with just how wide the range could be, depending on the different way you compose it and so on, because I feel there's a real danger in all of these fair deal debates of us assuming we've got far more precision than we do. So then we come to Gabby and George's essentially the same question. Before I get to that, I'd say there's just a small clarification. George, you said that the graphs would demonstrate what there is of a black swan of exports and so on. In fact, they demonstrate revenues to the government in the case of nationally led development. I probably haven't been as clear about it as I should have been, but I basically built the case for saying this is why the export dream is off the table. Once the export dream is off the table, you're then looking at a production cap because you need to find a market for the gap for the gas. Once you do that, then these kinds of scenarios look like they might be viable. So all of those dotted lines in that chart are against the assumption of scenarios for a nationally led market. Understood. So that's just, it doesn't solve the main question. Gabby says it's not viable. I would certainly be comfortable to say to you that it is challenging. But as to whether it's not viable or not, so I think part of what I felt it's been my responsibility to do, actually seeing a little of what Carol described and the sensitivity of the discussion inside the country, is to be the kind of blundering outsider, the bull in the china shop, and just to present what I hear European energy policy people saying in Europe, which is, it ain't happening. A pipeline to Europe ain't happening. But don't quite feel they can directly say, with their name to it in formal conferences or attributable formats or whatever. But, bureaucrats speak in all of the expert meetings I've been in, and all that's essentially what people are saying. So I've just decided to translate that into, modeling, to set our model parameters on those terms. So I am comfortable to say, to be decisive about that. I think the question of whether there's a viable national project is a different question, and I certainly haven't seen enough information and analysis to be conclusive about that. You've got a very big open question of the huge value, genuine value saved, and I haven't run the numbers on it because, as I say, all of this has been filtering in, really in the last month, as I've seen, reacting to where essentially the news flow takes us in one form or another. But it is a complex area. From what I can see, yes, there's been a number of power sector studies done and so on, but I don't think I've not seen an analysis which clearly joins up all the dots, which says, here's our attempt to estimate what reasonable growth of demand could look like. There's certainly a massive, genuine economic efficiency of conversion of the power network to gas feedstock, which is a driving commercial motive to make a lot of things happen at a national level, which might be difficult to make happen without that driving motive. That doesn't mean that it wouldn't be difficult, substantially difficult, at two different levels. And they are the level of assurances to the companies about payments and price levels, and the incredibly bitter pill to swallow of price liberalization in and around the gas markets. The electricity market. The end, I mean, and it's really complex, so the end result is, let's take a question like, well, if all of that happened, would gas become more expensive or not? And to me, that's at the moment an unanswerable question, because you can see it becomes more expensive with price liberalization. However, you could see that stable grid supply then becomes massively competitive to the private generator business. And so that's a countervailing effect. And I couldn't possibly tell you what the net balance is. But I also believe probably nobody can currently tell you what the net balance effect is or would be likely to be. And so I would say it is premature to come to the conclusion that there is not a viable project there. What if you run those numbers, which is its own separate complex piece of work, and you come to the conclusion, hey, it's actually possible that you could do that. And if you take the current prices people pay for electricity, not as what they currently pay the grid, but their average across the massively subsidized price they pay to EDL, if they pay at all, because we assume the substantial leakage, but the weighted average of that plus the massively high prices they pay to the private generator market. What if, when you'd run that analysis, it looked like, hey, people would probably be about the same? That then is a really substantial finding, which still makes everything difficult. But you then are into a new game in which you've got some substantial possibility there with a big packet of genuine saving. How you choose to play that internally, politically, and so on. I mean, you've got a very strong mercantile tradition in Lebanon. Reforms of the power sector have often involved substantial privatization. Privatization can also go wrong, can also collapse into crony capitalism. Nothing is risk-free. Those are very complex questions. But you do at least have the possibility to consider that, well, maybe it is possible. So I'm comfortable saying the big export market is off the table at one end. I'm comfortable saying it is premature to conclude from that at the other end that nothing is viable. And I'm comfortable in the big middle space to say it is certainly challenging, but here are the issues that need to be considered. And those should be perhaps the subject of next stage research, all of which, so I'm going to do the expert thing now and say all of which stop short of saying, here's the definitive conclusion about, the binary yes, no of is there a viable project or not. I hope that makes sense.
Yes, indeed it does. Thank you so much. Before I take any other questions, I'm conscious of the time. I think we have a couple of minutes more just to answer in a very short way regarding at least the comment that Carol, you said, so how are you fighting or actually confronting the politicization of the sector? Basically it's through just making sure that we have the debates are based, or all the discussions that are currently taking place are based on science and facts, and through, of course, advocating heavily on this. We are definitely, as LOGI, we're not think tanks, we're campaigners, but we're using all the science and the tools and the data possible to make sure that that's the basis for any form of discussion or reform that is proposed, instead of just political assumptions. And we've seen this lately, unfortunately. So just to also shed more light on the angle that we're tackling it from. I would like to open the floor for maybe a couple of more questions before we close, if there are.
This is George again. I have a very quick follow-up question, Johnny. I don't know if you have the answer to that, but is there a kind of a return expectations that companies usually ascribe to those this type of development?
Yes. So actually, I was just had a 3-hour conversation about this yesterday with someone who used to run this company wide for Maersk. So I'm about to present you with the theoretical way in which companies compile these statistics or metrics. But he was basically laughing at the idea that these are strongly and regularly executed well. There is more happenstance also on the company side than outsiders may assume sometimes. So I guess there's kind of two answers. One is at a project level, you've got standard metrics where companies look for a rate of return, which in jargon can be expressed as the internal rate of return or the IRR. And it has a kind of sister metric, which is called the net present value. And the idea of those metrics is that you're able to compare projects of different time scales, different levels of investment, different prices obtainable, and so on. They all get reduced into numbers where you compare project A with project B, because of course a company has, dozens, hundreds of projects, potential investment projects at a time that it's got in different stages of development, and it needs a way to allocate its capital, financial and human, across all of these different projects. So there are those metrics at an individual project level, and we've used those in the model. And you may remember one of the charts there is the break-even prices. Is kind of the blank spaces in the lower parts of the screen are where the rates of return for the companies have dropped below 10%. And so we regard it as in no way investable for them. That's how we're determining, what the minimum price needed for them to invest is against. But we also I should also emphasize again the health warning of all of the estimates for how much it would cost to develop a field. Not only are speculative for us because because we're dealing with public domain data and so on, they're speculative at this stage also for any company. They're speculative also for Total, because they wouldn't really know what the real costs are, which is part of the things that go into determining their rate of return, until they got a successful exploration well, then they'd drilled several more successful appraisal wells, spent 2 to 3 years more studying, spending $200 to $300 million more in those phases of study before they came to particular conclusions about the costs in that individual project. So also a word of caution on what the margin of uncertainty is, even on those metrics. And even for companies, you don't need to assume that our uncertainties are all because we're sitting on the outside. Most of those uncertainties are still uncertainties for companies sitting on the inside. And then at the wider company level, you have things like more metrics, like the weighted average cost of capital, which takes into account the fact that companies like to use project finance and borrow large amounts of money because they can borrow at lower rates than they can get share capital, and then more complex calculations out of that. So yes, those metrics exist, and we are using them because you can't really analyze what the best position for public policy is unless you are also trying to analyze what the business model of the companies is, because you want to get to a stage where they bid and then develop and accept the deal, but you get as much money as possible. So you can't get them to bid and develop the deal unless you can try to analyze what their business case is. So that's my kind of.
Thank you.
Great. Thank you so much, Johnny. Thank you for all those who attended and had also contributed with great questions and comments. If there are no other comments, I believe that we have reached the end of this very interesting, very informative discussion. So with this, I'd like to thank everybody for attending. Thank you, Kulluna Irada. Thank you, board members, advisory board members for LOGI, Johnny especially, a wonderful friend and a great mentor on these things. Thank you so much. We will have available the
Jana, I'm
recording.
sorry.
Yes?
Is it possible to have a copy of the slides that Johnny was
I
using?
leave it to yeah. Absolutely. And we will have the narrative published by OpenOil and the financial model itself with the explanation along with the recording.
And translated into Arabic.
Oh, yes, inshallah. And just for those who know, don't know, Johnny speaks Arabic and many other languages as well. So, shukran, Johnny. Shukran marra tani. That was really good, and have a lovely evening, everybody. Thank you, and thank you, Hala.
Thank you, everyone. Thank you, Johnny. Very informative. Thank you. Bye.
Bye.